What's up you guys? Welcome back to the Options Income Strategies channel here. In this video, I'm going to talk to you about the basics of options trading, all the way from what options are to the different kind of options there are and some basic strategies that you can use to come up with your own profitable options trades. Okay, let's get right into it. So what are options? Options are contracts between a buyer and a seller that give the buyer the right, but not an obligation, to buy or sell 100 shares of a stock at the specified strike price by the expiration date. So there are a lot of terminology that's thrown in there, but let me break it down for you. The reason I say that it's a right but not an obligation is because when you buy a call, at no point would you be forced to buy 100 shares of the stock itself, which is why you don't actually own it. You only have the right to own it, but you don't actually own the stock. Okay? But this is also another reason why if you have an option on a stock price, you would not get paid a dividend on that stock if that particular company does offer dividends. Okay? The strike price is the price that you're betting that the option would be by the day of expiration date. Okay? Now, when I give you examples further ahead, you'll have a better understanding. So now the type of option that you buy is determined by the direction in which you think the stock price would go. Okay, so if you're betting on the stock that it would go up in the future, then you buy what is called a call option. If you're betting that the price of the stock would go down, then you buy a put option. Now the value of the option, or the price you pay for it essentially, is called a premium. The premium determines what the break-even price would be for that option. So let's look into what call options are. Call options give you the right, but not an obligation, to buy 100 shares of a stock at the strike price with a bet that the stock price would be above that stock price by that expiration date. Okay? Here's an example. So if you have a stock trading at $30 on May 18th, and you buy a call option with the strike price of $30 for a $5 premium, and it expires on July 19th. So what you're essentially doing is that you're betting that the price of the stock would be at least $30 by July 19th. Now remember, I said a call option, or any option really, represents 100 shares of a stock. So if the price of that option is $5, then you actually have to pay $500 to buy that call option. Now, because you're paying a $5 premium with a strike price of $30, for you to break even on your option, the price on expiration date would actually have to be 30 plus $5, which is $35. And any price of the stock above $35 is when you actually start making a profit. Okay? And since it represents 100 shares of a stock, for every dollar that the price is above or below this break-even price, you will make a $100 profit or loss respectively. Now, the maximum profit on this trade can be infinite because the price of a stock can go as high as you can imagine. Now, realistically, obviously, it won't be infinite. A $30 stock may go to $50, $60, $100, $200, or maybe more, but there's obviously a limit to it. But the maximum loss would be only the full $500 that you paid to buy that call option. And the maximum loss would be at any price that's $30 or below. Between $30 and $35, that loss would be reduced by $100 for every dollar it's above $30. Okay, let's look at an example here. So we go to a website called optionsprofitcalculator.com. I'll put a link to it in the description. And this is a great website that you can use to try out different option strategies and theoretically estimate what your profit will be, what your maximum loss might be, and how you can use different strategies to hedge and minimize your losses. Okay, so I'm going to buy a long call. Long essentially means that you're buying something, short means you're selling something. So I hit on long call here, it's already opened up here, and I want to look at Facebook stock. So you type the ticker symbol here, click on get price, that's the current price of Facebook. Now you go to select option, let's say a month out on June 19th, you're betting that the price of Facebook would be at least $230. Okay, which is great because it's already at $230. So ideally, you don't want to go too far ahead on the strike price. So let's say you're betting that it would be at $230. Now, the price of that option for the $230 strike is $9.15, meaning for 100 shares, you're paying $915 to buy that call option. Now you hit calculate. Now this will show you what your maximum return is, which is infinite in this case. Your maximum risk is the price you paid for it, which is $915, and it breaks even at $239.15. The way the break-even price is calculated is to add the price of the option to the strike price, and that's how you come up with $239.15. And a easy way to visualize how the option is going to behave is on any given day between today and the expiration date, which is June 19th, the option will vary between these price ranges above this final curve. Okay, this dark brown curve here, that would be the price on expiration date. All the lines here are on different dates, as you can see by the legend here. So it breaks even at $239.15, and all prices above that price is when you start making a profit. Between the strike price, which is $213 and $239, you lose money you essentially lose money between $0 and $915 as the price drops between $239.15 and $230. And at any price below your strike price, you will lose the full debit of $915. Okay, so those are called call options. Next, we get into put options. Put options are the opposite of call options, where you're betting that the stock price will be below the strike price by the expiration date. So, same example as before. You're buying a stock that's at $30. You're buying options for a stock that's trading at $30 today, and you're betting that the price will be below $30 by expiration date. But since you pay a premium of $5 for it, for you to break even, the stock would at least have to drop to $30 minus $5, which is $25. And since we are assuming the same premium, you still pay $500 to buy this put option. And for every dollar below $25 that the stock goes, you will make a $100 profit. Okay? And at anywhere between $25 and $30, you lose $100, and it's capped at any price above, at or above $30, and the maximum loss you would incur is $500, which is the amount you paid to buy that put option. Now, as opposed to a call option, since the price can only go as low as $0, your maximum profit is also capped at $25 times 100, which is $2,500. Okay, let's look at a quick example here. So I put a long put option here. Again, you just click on long put here. Let's look at Facebook again. Go to select option, same June 19th. Now let's say you're betting that the stock price would be below $220 by June 19th. Hit calculate. And now you see that the break-even price is $214.72, which is $220 minus the price of the option, which is $5.28. At any price below that break-even price, you start making a profit. Between $214.72 and the strike price, which is 220 cents, you lose $1 for every dollar that it's below the break-even price, and the maximum loss will be at $220 and above, where you lose the full $528 debit that you paid to buy the put option. Okay. And the maximum return is if the stock price goes all the way down to zero from 214. So 214 times 100 is 221,400, approximately $21,472 for your maximum return. Okay, so that's a put option. Now, to understand what strike price you should choose for a call or put option, you need to understand what in the money, at the money, and out of the money options are. Okay, in the money options are options that have a strike price that is below the current stock price for a call option, but that are above the current stock price for a put option. At the money options, as is obvious, are the same strike price at the current stock price, and out of the money options are options that are above the current stock price for a call option, and but that are below the current stock price for a put option. Okay, so in the money options have the highest probability of succeeding because in the money options are already at a profitable price compared to the stock price. Okay, but because so I mean you'll understand it better when I show you an example, but the more in the money an option is, because you have a higher probability of succeeding, the premium would be higher. Okay, so say for a call option, the lower the strike price, the higher the probability of winning because you're more in the money, but you also pay a higher premium for it. Okay, and conversely, for a put option, the higher the strike price, the higher the premium, but you also have a higher probability of winning. Okay, so if I go back to Facebook again, select option, everything on this side is a call option. Everything on this side are put options. So for call options, everything below the current price of the stock, which are all these values, they're in the money. But at $230, that's at the money, and all these numbers here are out of the money. Conversely, for put options, all the strike prices about $230 are in the money, and all of these are out of the money. Okay? And as you can see here, the more in the money you get for call options, the more expensive the price of the option. And the more in the money you get for put options here, the higher the premium. Okay? So to understand how options behave, there are different factors that control how an option changes on a day-to-day or daily basis, okay? And those factors are called the Greeks. Now, in my honest opinion, the Greeks are not that important for the kind of strategies that we are going to implement, because the Greeks only determine how it's going to behave between now and the expiration date, and also on a day-to-day basis are how it's going to change is not that important for you, because we buy an option determined by um, where you think the stock price will be or in which direction the stock is going to go. Okay, so remember, if you have a really good conviction that the particular company is doing really well, that they're being profitable, and you expect the stock price to go up in the future, then you buy a call option with a certain strike price that's in the money. Okay, so how it changes on a day-to-day basis is actually irrelevant to you, because at the end of the day, as long as the stock price goes up, you make money on it. Same thing with put options. If you believe that the stock is overvalued right now and that it's going to drop, you buy a put option, and how it changes on a day-to-day basis is not that critical as long as you're below the break-even price where you start making a profit. Okay, but the interest of you learning how they even work and why options behave the way they do, I want to get into some high-level details of what the Greeks are, so that going forward you understand what they really mean. Okay, so this is a screenshot of how an option looks like when you're about to buy it. So this stock is currently trading at $34, and this particular option price with the strike price of $34 is worth 92 cents. So what that means is your break-even price is 34 plus 92 cents, just $34.92. Okay, what it's saying is the stock has to go up by 3.62% for you to break even, and anything above that you start making a profit. So the first Greek here is called delta. Delta represents how much the options price is expected to change per $1 change in the stock. Okay, now if the stock price goes from $34 to 35 cents, then your option price would change from 0.92 to 0.92 plus 0.4614. Okay, and this is all between now and expiration date. Now, deltas range from 0 to 1 for call options and 0 to -1 for put options. Okay, in the money options have a higher delta and they approach 1 by expiration date, because on expiration date the way option behaves is for every dollar it goes up, your delta would have to be 1 because the price of the option would change by $1. Okay, how do the money options have a smaller delta and they approach 0 by expiration? Let's look at an actual example. So this is my Robinhood account here, and these are the different options that are available for Facebook. So it's currently trading at $230. So if I look at an option with the strike price of $235, if I click on it, the delta is 0.4332. This is out of the money. If I go more out of the money, say $245 here, the delta is even smaller, 0.2728. But if I go further in the money, below $230, say $222, your delta is 0.6821. Okay, so that's what I meant when I said the more in the money you get, the higher your delta is going to be. Gamma, that's your next grade. Gamma represents the rate at which the options price is expected to change per $1 change in stock. Okay, so the difference between gamma and delta essentially is like the difference between speed and acceleration. One represents how much it's going to change by, and gamma represents at what rate it is going to change. Okay, it determines the difference in delta as the stock price changes. So in the screenshot, you see the gamma is 0.1449, which means that the delta, which is 0.4614, would change by 0.1449 for a dollar change in the stock price itself. The gamma keeps reducing as you get more in the money and it approaches 0. It's never actually 0, but it approaches 0. It'll only be 0 on expiration date. Theta is your next Greek. Theta represents the time decay of the stock, and it measures the change in price of the stock per day, assuming all other factors remain the same. So let's say the stock price stayed at $34 between today and tomorrow. What that essentially means is that the price of the option would drop from 0.92 to 0.92 minus 0.1361. Okay, that's what theta would be the next day if the price of the option stayed the same. Now, obviously the price of the option usually doesn't just stay the same, which is another reason why I say that looking into Greeks is not that critical when you're determining which option to buy. Okay. Now, the farther the expiration date, the slower the decay, and the smaller the theta, and vice versa. Another factor that you need to look into is called implied volatility, which is right here. And for this particular stock, the implied volatility for this strike price is 77.88%. So implied volatility, as it sounds, it represents how the price may change going forward. The high IV means that the option price is currently very volatile and is more expensive than normal. Implied volatility for at-the-money calls tends to be the lowest because the price is already at that option. So high implied volatility is good for option sellers, and low implied volatility is good for options buyers. Okay, why do I say that? It's because if the implied volatility is too high, say it's greater than 100%, which a lot of times it is, then it means that the option has already gone up a lot and it's probably too expensive, and it may not be a good time to buy that option. So now that we've gone through some basics of how options actually behave, let's get into how to actually make profitable options trades. Okay, so at any given time there are 5 possibilities for a stock price in the context of an option. Okay, so the price could go up a little, meaning that it could go up from the current price to the break-even price for a call option where you would still lose money. It could go up a lot, which is above the break-even price where you would start making profit on calls. Price could stay the same where you would lose money on both calls and puts. The price could go down just a little bit from the current price to the break-even price for puts where you lose money. And the price could go down a lot below the break-even price for puts, which is where you start making a profit. So what these 5 scenarios essentially tell you is that if you buy a call option, you will actually lose money in 4 of these scenarios. Same thing with the put option. Unless the price goes down a lot, you actually lose money in all four other scenarios. Okay? It's for this very reason that selling options provide an 80% chance of profitability, and is thus a much better way to trade options than just buying calls or puts. Okay? Now, there are several strategies that you can implement where you're using a combination of buying options and selling options and hedging your bets. Okay, a lot of these are advanced strategies, but since this video is targeted mainly for beginners, I'm only going to focus on the basic strategies. Okay, let's look at it one by one. So, what are naked calls and naked puts? Naked calls and puts are options contracts that you open by selling a call or put, respectively, as opposed to buying a call or put. Okay? If you don't already have 100 shares of that stock, then most brokerages either don't allow you to sell a naked call or put, or they require you to have enough cash in your account that is equivalent to 100 shares of that stock, and that cash would be used as collateral. So, in my opinion, I never sell naked calls. I never make naked calls or naked puts. I never sell calls or puts if I don't already own 100 shares of that stock that I can use as collateral. Okay, selling a call option is also called short selling. You probably heard that in the news all the time that someone is shorting a stock. Tesla, for example, has the most short sellers because they think the price has gone up too much. They think the company is not actually worth that price. So they want to short it, meaning they want to sell call options, betting that the price would go down. Okay, and as the price go down, they get to keep all the premium that they sold, and then they can buy it back at a cheaper price where they think it's more fairly valued. Okay, so since I don't actually ever do naked calls or puts, I'm not showing you an example, but I will show you an example for covered calls, because covered calls are a great strategy that you can use when the market is very volatile or you think a company is overvalued. Okay, so covered calls have the same concept as naked calls, where you're selling a call option to open, but you already own 100 shares of that stock, which you can use as collateral. So during a market crash or a temporary dip in that stock, covered calls are great strategies that allow you to cover your losses as long as the price of the stock stays above the strike price. Okay? As an example, say you own 100 shares of a stock at $35 a share, and you sell a call option with a strike price of $30, and you collect a $6 premium from it, which is $600. Now, if the stock price does go down to $30, the value of the shares that you own, which is $3,500, would drop by $500 if the stock price goes to $30. But at $30, this call option that you sold would expire worthless because it's below the break-even price of $36. And so you get to keep the full $600 premium. And even though you lost $500 on the shares, since you got a credit of $600, you actually made a profit of $100 while the price of the stock went down. So that clearly shows you why this is such a great strategy that you can use during a market crash where you're covering your losses and actually coming up profitable while the stock price goes down. Okay, let's look at an example. So let's look at Facebook stock again. Let's say you own 100 shares of it, and you say select an option. Now remember, you choose a month out, and remember that you're betting that the price would go down. So say you sell a call with a strike price of $200, betting that there's a good chance the stock might drop in the future. So you're selling a call that will go down to $200. For selling that call, you get a credit of $3,138. Okay, you can calculate. Let's look at the graph. Look at this. At any price above the break-even price, you actually make money on it. Okay, it breaks even at $198.57, and for every price above here, which is $201 in this case, you get to make a profit of $143. Okay, if you want to understand how you make $143, you can just click on it and it shows you the math here. It's saying that at $202.50, the price of Facebook, as it dropped from $230 to $202.50, the value of it dropped by $2,745. The price of the option that you sold is worth $2.50. So it's worth $250 here. So when you close this trade, it's like the value dropped by $2,995. But because you got a credit of $3,138 for selling that call, you still made a profit of $143. Okay? Now you sold out of these stocks, you bought back this call option at a price of $250, and using that entire money that you got from selling the shares and buying back this particular call option, you can use that money to buy back Facebook at $202.50. You did not lose any money from it as it dropped from $230 to $202, but now you have a much lower average cost basis. Okay, that's the real beauty of covered call options. Let's look at the next next strategy that you can implement. Now, this is one of my favorite kind of strategies that I use on a very regular basis. Okay, they're called credit spreads. So a credit spread is a strategy where you buy and sell options simultaneously at different strike prices, but the option that you sold has a higher premium and thereby giving you a credit for opening that spread. Okay, a call credit spread involves buying a call with a higher strike price and selling a call with a lower strike price. Okay, remember, the higher the strike price for a call option, the lower the premium it would be because it's out of the money, right? But you sell a call with a lower strike price, which is either less out of the money or more in the money, right? The premium would be higher, so you get a credit from it. Okay, so when you're executing a call credit spread, you actually have a bearish stance on the particular stock. Bearish meaning you're expecting the price will drop. Okay, so when you execute this strategy, even that has a certain break-even price. I'll show you in an example. And as long as the price stays below that break-even price, you get to keep the full credit. Okay, and the inverse of that is a put credit spread, where you buy a put with a lower strike price, you sell a put with a higher strike price, and you get a certain credit from setting up that strategy. Okay, a put credit spread, as converse to this, is a bullish strategy, meaning that you're betting that the stock price would be above a certain price, and above that break-even price, you get to keep the full credit. Okay, now the difference between just buying a call option or just buying a put option is that your losses are far more limited, because just by how the price of the option would be during expiration. I'll show you in an example of how that works, and you'll understand it better. Okay, so and also you're not paying any money up front to actually open the spread. You're actually getting paid a certain credit to open the spread. Okay, since you're not actually paying anything, but there are chances of you losing money, your brokerage actually wants to make sure that you have enough cash in your account to account for those losses, essentially. And it uses a certain amount of cash as collateral without you requiring to own any shares of that stock. Okay, let's go look at how a call spread looks like on Facebook. So in spreads, go to credit spread, type the symbol here, Facebook. So remember, this is the long or short option. So for a call, if you're trying to buy a call credit spread, you want to buy a call that is very far out of the money. In this case, let's say $250. Instead of 20-second bay, let's choose a month out. Let's say I want to buy a call at $250. And then I sell a call for June 19th again at a lower strike price, say $245. Okay, so look at this. You're getting a credit of $107 for opening this call credit spread. Hit calculate. So look at this. This is the entire range where you would make a profit, and that profit is 27.2%. If we look at a graph, well, yeah, at any price below $245, you get to keep the full credit of $107. Okay, It's only about this break-even price of $246.07 that you start losing some money, and your risk is capped at $393. Okay, so this is a very effective strategy because even though it looks like your risk reward doesn't look that great, the probability of this credit spread being successful is a lot higher. Okay, and the way you can increase the probability of this is you can push out the spread even more. Say instead of buying the 250 call, I could buy the 270 call and sell the 265 call. You hit calculate again. You get a smaller credit of only $23, but now your break-even price is $265. Okay? That's a call credit spread. Now with put options, you're betting that the price would stay above a certain level. So that's why you want to buy a put credit spread with a break-even price that is below that's far below the current price. So let's say I buy a $190 put and you sell a put with a higher strike price, let's say $195. I hit calculate. I get to keep a credit of $25 for opening the spread. And at any price above $194.74, you will get to keep the full credit. Okay? And only at a price of $190 or below, do you risk the most of $475. Okay? Again, if you want a higher probability, go further below. Instead of a $190 call, go to $180. And you sell the $182.50 put. Hit calculate. You get a far lesser return, but a much higher probability. Okay? And usually, since the risk is, say, $244 now and 400 something in the previous case, your brokerage typically sets aside $500 as collateral just in case you do lose this bet. So those are credit spreads. It's one of my favorite strategies, and I use them very frequently. Next, you have debit spreads. This is personally my current favorite strategy to use because in a way it's the same as credit spreads, but it's the inverse strategy. Okay? In this case, you're buying a call for a call debit spread. You're buying a call with a lower strike price instead of a higher strike price, as was the case for the credit spread, and you sell a call with a higher strike price. Okay? Now, call credit spreads were bearish strategies, but call debit spreads are bullish strategies because you're betting that the price would stay above a certain break-even price. Okay? And as long as you stay above the break-even price, you will make a full profit, and the percentage profit is determined by the price of the options at the time of expiration. A put debit spread is where you buy a put with a higher strike price and you sell a put with a lower strike price. Okay? Put debit spreads are bearish strategies as opposed to bullish strategies for a put credit spread, and you're betting that the price will stay below a certain break-even price and you make a certain profit based on the price of the option on expiration. The biggest advantage with the debit spreads is that you don't need any cash as collateral. Okay? That's the biggest advantage. For credit spreads, there's always collateral that's going to be used. And even though that's not really a problem and you're not actually paying any interest on it as such, the biggest downside is that when that amount is being used as collateral, you cannot use it to buy any more shares or open any other credit or debit spreads. So I personally prefer debit spreads, and you actually get you have a much higher risk reward. Or rather, much higher reward compared to the risk. Okay? And the maximum loss is always only the debit that you paid to open that spread. Let's look at an example. I actually want to show you a couple of examples that I'm using right now because I'm a big fan of this strategy. Let's click on call spread. Let's look at Facebook again. I don't get price. Now you're betting that this price would go up. Now, for you to increase the chances of this profiting and to increase your returns, you actually want to buy options that are much farther away. So instead of just 1 month, let me take 7 months and go all the way to January, or 8 months. Okay. And I want to say, to increase the profitability of it, let's say I choose a pretty low break-even price. So I want to buy a call with a lower strike price, so 225, for example, and then I sell a $230 strike price. And to open this, I have to pay $275 because this is a debit spread. Now look at that. So as long as the price stays above the break-even price of $227.75, which is below what it is trading at currently, you make an 81.8% profit. Okay, that's really the beauty of debit spreads. That's how I really have been outperforming the market, because you pay so little to get a much higher reward. Okay, think about it. If you pay $275 for Facebook, you would just get one share out of it. And if the price goes from $230 to $227, you actually lost about $2.25 on that share. But in this case, you pay $275 and you get a return of $225. This is actually the profit, by the way. If you click on this, you actually are closing it at $500. But because you paid $275, your profit is $225. So think about it. For the price actually dropping or just about staying the same, you're making an 81.8% profit on it. Okay, that's the beauty of it. Now, if you can buy more than one spread, for example. So you bought 5 of these calls and sold 5 of these calls, hit calculate. Now you paid $1375 to open it, but upon selling it at the break-even price, you can close it at $2,500 and make a profit of $1,125. Isn't that amazing? That's really the beauty of debit spreads. Okay. Now, if you want to increase the profit percentage, as if 81.8% is not enough, you actually have to increase your break-even price. Okay. So instead of 225, let's say I buy the $240 call, and I buy the $245 and I sell the $245 call. I hit calculate. Look at that. Now you're paying only $1,100 for opening 5 of this debit spreads, but your maximum return is 127%. Okay? When you sell it, you make $2,500, but because you paid only $1,100 for it, you're making a profit of $1,400. That's really the beauty of debit spreads, which is why it's my absolute favorite strategy. Okay, if you look at a stock that actually fell a lot recently, let's look at a Boeing, for example. Boeing dropped from highs of 400 something to only $133 now, and this is actually a debit spread that I myself own in my portfolio right now. So since Boeing already has gone down a lot, and the government is probably not going to let them go down more or go bankrupt, they will probably bail them out. I am willing to bet by January, the price will at least be more than $133. If not 200 or 300, I'm willing to bet that it will be at least more than $133. Okay, so I could buy a $130 call and sell a $135 call. You hit calculate, you pay just $212 to open this spread, and you can get 136% profit just for not even changing. Look, the break-even price is only $132, which is below the current price. Okay? If you want to be a little more aggressive, you can buy the $145 call and sell on a $150 call. Hit calculate. Now your risk is only $190, but your return is 163% with a break-even price of $146.90. You could buy, say you have $1,000, buy 5 of these for just $95, and now you can make a profit of $1,550, which is 163% profit. Okay, so that's really the beauty of debit spreads, guys. It may take some time for you to come up with your own strategies, but as long as you try out different things on that website, optionsprivatecalculator.com, and you have a strong conviction behind how you think the company is doing, whether they're going to go up in the future, whether they have a lot of good things going on for them, or if you think they're overvalued and you think the price needs to come down for it to be more fairly valued. Depending on what your conviction is towards a particular stock, try out these different strategies and try to come up with profitable trade ideas. Okay, I'm going to keep sharing with you the different strategies that I'm implementing right now. You can use them, do your own research, get your own understanding of why I set up that particular trade strategy, and you can come up with your own, or you can follow along what I'm doing. Okay, so I hope that's been really helpful, you guys. I had a lot of fun putting this together. I really hope this was very helpful for you. My goal is that once you're done with this video, you would be in a position to be able to explain it to someone else. And when you're in a position to really explain it to someone, that's when it shows that you have a much better understanding of it than you did before. Okay? Thanks a lot for watching, you guys. If you liked it, please smash that like button. It will really help out my channel. Leave a comment if you have any questions, or if you understood everything perfectly, leave a comment on which strategy that you're looking forward to try out. Okay, I would love to hear from you. Start small, start with $1,500. Don't jump into thousands of dollars right away. And as you get a better understanding, you can start scaling up. Okay, that's all I wanted to share, you guys. Please subscribe and hit the notification button if you haven't already. Thank you for watching, and take care.